Let me open Q&A. You can ask your question to the whole, to the panel as a whole, and then we decide how we answer this, or to any panelists. So, any questions? Yeah.
Yes. Is anybody giving thought to the doomsday risk in CCPs, where your risk is not your book, but the mutuality of the guarantee fund? If you're a member of a CCP, you are at risk mutually for the performances of all the other members. And so when there is a serious crisis, your exposure isn't simply your book. It is whatever they call on you for to perform for whoever's just dropped dead. And if it gets bad enough, whoever is still standing is responsible for a greater and greater portion of whatever the outstanding book is at the CCP. It's much more remote, but it's colossal.
Yeah, actually that's a topic that generated a lot of discussion of late. Clearly, and I think that's a scenario that people are envisaging, and especially in the context of multiple CCPs that we have today in the marketplace. So right now, the guidance that firms have is to have adequate capital against the risk that you run on CCPs. The mutualized risk part is very difficult to quantify and measure. One of the ways in which industry is trying to deal with it is classifying CCPs as QCCP or CCP that comes under the CBSS, IOSCO guidelines. So in which case, it's not very clear, but looks like there is some backing from the government or regulators for these CCPs. As a result, there is a different way of calculating risk that you run against portfolio that you clear through these QCCPs. So there's still some debate around how it'll eventually get finalized. But clearly, that's a concern that industry has today.
This question is for Doug. And could you comment a little bit more about what format of CVA risk transfer can take, given that the regulator is quite sensitive about capital arbitrage trades, and also tranche CDS protection is not allowed?
The simplest way to transfer counterparty risk from one institution to another is through a CCDS, a contingent CDS. I think that we are not seeing a whole lot of activity in CCDS at this point for a variety of reasons. One is that a large amount of the uncollateralized risk in the market is corporate risk for uncollateralized hedging counterparties. And given the uncertainty as to what the final state of the regulations is going to be, people are refraining from doing anything there. And the remainder of the risk in financial institutions tends to be gap-type risk, which is quite a different animal and is less well served by a CCDS because the size of the jump when the default occurs is really what you're concerned about, not so much the movement of the product over time because you're collateralized up to the point of the default. There are a few banks who have done first loss trades that they had hoped to get capital relief on for both the jump to default component and the VAR component of the capital. They have been told by their regulators that those trades will not work for that purpose. And they are, at this point, looking to complete the capital structure, so buy protection on the rest of the stack. Those trades tend to be very large trades with many, many counterparties, a lot of financial counterparties in them, and there's not really much known about the underlying risk aside from generic statistics about who the counterparties are that are referenced in the trades. I expect that we will continue to see trades like that done over time because it's a relatively efficient way to transfer a lot of risk. I also think, though, that we will see, as regulations become more clear, if corporate risk is not excluded, so you do have to hold the capital against it, I think people will be looking to hedge out large exposures that they have, so a tall trees kind of approach, and potentially in a portfolio context. It's much more efficient to do it in a portfolio context because you can get your directions in rates, for example, versus credit in both directions, so that there's some offset you get to the cross gamma you have in the portfolio. So I think people will be trying to come up with efficient portfolios for trying to hedge out some of that exposure.
So maybe there's something I'm missing here. If a lot of the OTC trades go to the counterparty, central counterparty, right? Is it safe to assume that you're going to be computing your CVA, taking, I mean, hypothetically, some spread which is the central counterparty? I mean, how would that play in setting aside a CVA capital if you're actually centrally clearing those derivatives?
Most end users, because I think when you're pricing the CVA from our perspective, you have a CVA price for a financial institution, but a lot of the because that's margined, the CVA is a lot smaller with the financial institutions. But the CVA on the corporate side, most corporates are going to use the end user exemption that is in the Dodd-Frank Act, and so that business will most likely continue to function the way that we know the OTC market to function. It's just going to be a more expensive market because of the things that we talked about, where you're going to have to hold more capital against this business in various spaces, whether it's extra capital against the CCP, extra capital against CVA VAR. So the trade itself will be more expensive, but the CVA pricing against the corporate is still being based on that corporate's credit spread. And you would intend to still hold that OTC trade. It's going to be your hedge with the finance. So now you hedge that trade with the financial institution. That's the trade that has to be given up to the CCP.
I just wanted to ask, with CDS volumes declining because of the regulatory disharmony and also because of people might be waiting for the credit futures, how is that impacting the ability to hedge CVA? And also, do you see maybe a re-emphasis on break clauses as a way to gain some CVA relief? And then for separately, the thresholds on the margin, you were referring to the 50 million euro threshold, I believe. Well, if that's split for counterparties, do you really think that that's going to be make an impact or make a difference?
Let me answer the threshold question first. Okay. So the threshold concept is something that is being debated right now. I think the final rules are expected somewhere in April, later part of the month. So the idea is that on a bilateral basis, when you have to post margin, initial margin, they want to keep 50 million euro as a threshold. So only if you exceed 50 million, then you actually start posting initial margin. The QIS study says that because of that, there is roughly about 50% reduction in the capital that you require for bilateral books, that the OTC derivatives that you have that are not being cleared. The second interesting fact from that study is that the counterparty pairs that you would have without the threshold are something like 100,000, and with the threshold that will come down to about 3,700. So there's a big impact based on their study. Obviously, we need to see that in practice to see if that study is accurate or not.
Just commenting on that from a practical standpoint, they talk about these thresholds where for the trades that do remain in the OTC market and the corporate has the end user exemption, and that market continues to look like the OTC market that we've known. Then we have this additional non-cleared IM that is going to have various thresholds as to when you may or may not have to actually exchange that margin. The rules are, as they're written though now too, are requiring firms to have to calculate it. So even if you don't call that margin, you have to evidence that you calculated it each day, and made a decision that it was below the threshold for whatever that group of counterparties is. And again, looking at the practical aspects of a lot of this, that's just a lot of additional calculations that have to be done each night and a lot of infrastructure that has to be put in place.
With respect to CDS liquidity in the market, I obviously will have, the lack of liquidity will have a very negative impact on CVA desks' ability to hedge their exposures. And there's not much that can be said about that aside from the fact that it'll have a negative impact. Break clauses operationally are difficult. They also require, if you have the market risk in your book and you hit a break clause, you have to replace the market risk, so they're also expensive. So I'm not sure whether we'll see increased use of that or not.
Yeah, there's a real, I mean, to your point with the liquidity of CDS, there's a real practical reality that has to be addressed, even when you look at Basel III and CVA VAR and what they're allowing as hedges to reduce capital, when so many of banks' portfolios are from a credit standpoint not hedgeable in the single name CDS market. You know, there's just speaking from experience at Wells, it's a tremendous amount of middle market commercial corporate names that aren't hedgeable in the CDS market, and that's the practical reality of it. Even though in theory we can all talk about a liquid CDS market, and that's just not the practical reality of what banks face when they need to hedge out their CVA exposure.
I think in the past, and still, there are large exposures sometimes that are in liquid CDS names where a liquid CDS contract can be very effective. One of the things that people don't pay attention to is the structural change aside from the regulatory changes in the CDS market, is the fact that the synthetic CDO market has gone away, which was a big source of protection sellers in the market. So it was really the banks would transform tranched protection that they bought from investors into single name CDS that they could then sell to bank portfolio managers and CVA desks. And that's gone away because the synthetic CDO market is gone. Although I did see an article saying it's coming back.
Hi, this question is probably mostly for Tammy. In terms of you're talking about the infrastructure cost of calculating all your charges on the CVA book. The smaller group of the currency card banks, never mind the ones that are going to come in this year, don't really have CVA or a proper CVA book, and they manage counterparty in more old-fashioned ways, let's say. At the same time, so they don't have that infrastructure. At the same time, their models are not approved for internal use, so they have to use standardized models, which make it more expensive. Do you, or has anyone done any research or study kind of where those costs start balancing out?
And that's a great question. I have not read any studies. If somebody's done them, I haven't read them, but I'll share my intuition with you, is that that's still being worked out in the market. We've seen smaller banks exit this space entirely, and it's because on some level, somewhere within their firm, they've decided that it's already too expensive. And I think it remains to be seen whether or not, again, I think there will be unintended consequences to central clearing OTC derivatives, and I think that may be one of them as well, is that these smaller banks did provide some liquidity in that space, some liquidity, and when they exit, you're going to. The question, I think, is whether or not there's an unintended consequence that we've got now all this concentration in the CCPs, and we have fewer players in the OTC market, and so we're going to end up with just more concentrated risk in that space as well. But I don't know where that break even is, and I'm sure it's different for every firm, but we've absolutely seen firms exit the OTC space altogether at the smaller side.
Maybe this is the last question because I'm hearing beer bottles clinking in the back, but I don't know if this is for Doug or Tammy or who this is for, but I'm wondering if you have some insight as to how much the products that were mentioned earlier, the futurized swaps, might benefit from all this stuff that we're seeing. And Doug, maybe in the context of talking to dealers that in particular are in the interdealer market for swaps, whether this instrument really will get a big shot in the arm.
I think there have been multiple efforts to start up swap futures markets that clearly don't get the dealers particularly excited because the profit potential is much lower on the futures contracts than it is on bilateral trades. There have been mistakes made in the design of the contracts in the past, which have created problems at certain points and slowed the progress of those trades. It seems to me that the preferred course and probably the path of least resistance is more towards doing bilateral trades and then giving them up to the clearinghouse once they're already done. It may be a more efficient way for the seeker of the hedge to find the provider of the risk. Because ultimately somebody's got to take the market risk that's associated with those trades. And typically and historically that has been the dealers who have been interested in trading that risk. Obviously there are a lot of things that trade on futures exchanges that have large volume and a fair amount of risk associated with them. But if you are trying to hedge out $1 billion worth of interest rate risk that's coming off the back of a bond issue, I think you're going to have, for a long time, you're going to have a hard time trying to do that with the swap futures market.
We have time for a couple of more questions. So.
Any thoughts on CVA securitization as a way of hedging CVA risk?
What do you mean by CVA securitization? Do you mean just a bank doing a tranched trade?
I mean, the latest I checked, there are some banks, including SocGen, trying to offload the CVA risk by securitizing it. I mean, it's something new. I'm just curious about who would take the risk. Like, who would you sell it to? Would you have investors who would be interested to take a view on the counterparty risk that the bank has?
There have been several trades that have been done by Swiss banks, which have been in the press. In particular, there's a Credit Suisse trade that was done where their employees took a mezzanine tranche of the counterparty book, and there was an attempt to place the senior risk in that trade with a private investor that didn't succeed. And they are now trying to place that risk in the market through other means, which this is not private information, this is in the press. So there are attempts to do it. There's a different regulator associated with SocGen than there is with the Swiss banks. So whether the regulator is going to allow them to take capital relief on that trade or not, I don't know. They may be just doing it for risk transfer purposes. Those trades look a lot like bank loan portfolio trades. There's usually a cap on the amount of exposure that you can have to any one name. It's usually a blind pool. It's usually well diversified. I don't see any reason why that risk can't be placed through securitized products, other than the fact that the banks want to get capital relief out of the hedges that they're doing, because it doesn't make sense to pay the cost of the hedge and then not get capital relief as well, unless it's a strange exposure that you just really have to get rid of. I think people would be interested in taking the risk, but whether that can get any traction because of the fact that it's a tranched product and it doesn't give you relief from the VAR component of the capital remains to be seen. I'd be surprised if that happens because I think it's an expensive way to get risk relief on just the first loss.
If I may comment on the, nobody asked me anything, so I'll just jump on this, right? So, from quantitative point of view, it's, so what I said about wrong-way risk, it's hard to quantify, hard to calculate. This kind of problem, tranching of CVA, is this kind of problem squared because not only you have to correlate your market factors with your time of default of your counterparty. Now you have to do this with all counterparties, and you have to take correlation between counterparties and to default because it's tranche, right? It's so you need losses, expected losses based on correlated default. So I'm not sure how the Swiss banks calculated this spreads. It was around like 16, 19%, I believe, for MES tranches, so where it was coming from and so on. But from quantitative point of view, it's extremely, extremely hard problem. So that's my comment on this, yeah. Last question.
My question is for Tammy. You mentioned the non-cleared IM. Now, is this something that is decided mutually between the counterparties, or it is dictated by the regulator?
The regulators are going to have some say in how it's calculated. The latest, and you may know more, so jump in and correct me if I'm wrong here. But when we last looked at it in detail last fall, it's saying that you need something like, it's a 2-day 99% IM number. Now, both firms are going to both calculate a 99% number in whatever way they calculate it. And then there are prescriptive kind of rules about who has to call who and whose number you'll use. I think that adds an element of complexity too when you're calling IMs off of models that are unlike a CCP where if you're a member of the CCP, you get some visibility into how they calculate their IM and you can understand that and replicate it. But when all of these non-cleared OTC counterparties are each independently calculating their IMs, and there's not going to be, I don't know, I guess visibility or transparency into that, and that's going to create an element of difficulty too. But it'll have to be worked through in the marketplace.
Yeah, I was just going to say the way initial margin needs to be calculated, at least based on the latest prescription from regulators, is that it's one tail risk, 99% confidence interval over a 10-day horizon. So that's what they're saying, and the 10-day horizon needs to be incorporating the credit crunch period that we've experienced in 2008. So they are getting fairly prescriptive about how IM needs to be calculated.
I would suspect that the dealers will do the calculations for non-dealer counterparties, and they'll just agree that the dealer will do it because that's the way it's always been done. And I suspect that there will be, eventually there'll be some agreed upon model because I think the potential for very, very lengthy squabbles over what the IM should be between two large broker-dealers in the market who both feel that they are the smartest and best that are out there will wind up wasting a lot of time, and I think people will throw in the towel and come up with a standardized model that they can use. But that'll probably take some time, and the rules will probably evolve over time along with that model.
Okay, as I said, we are amazingly punctual, so it's right on time. We can continue our lively discussion during reception. Let me thank our panel.